A warm welcome to all our viewers. Welcome to the webinar on Introduction to Fundamental and Technical Analysis. So this is the first session that we will be conducting, and we hope to follow up this program with few other sections and uh, go to more advanced levels. So the main focus of today's webinar is to provide a basic understanding of how to do fundamental analysis. That would include how to analyze the basic financial statements and how to start technical trading. There again, the very basic fundamentals. Some of you might be new to investing in the share market. There might be some people who are more experienced. Some might be having background in finance. Some might not have. So for the benefit of all, we would be starting with the very basics of fundamental and technical analysis. So to start with, I will be basically conducting the fundamental analysis part of it. My name is Charitha. I'm the head of research for IC Securities. And once I have completed this, Mrs. Saliya will be taking you all through the technical analysis session. Okay, so let's start with the very basics of fundamental analysis. So as I said at the outset, we are targeting the people who we assume that many of you don't know the basics, and we're going to start with the basics. Right. So what's the scope of the presentation under fundamental analysis? Basically, we are going to discuss about analyzing the key financial statements. Now, when you say key financial statements, there are three main financial statements that we look at, starting with the income statement, which is also known as the profit or loss account, statement of financial position, mostly known as the balance sheet, and the cash flow statement. So we would be looking at these formats and what to look in them and how to analyze them. The second main thing that we are going to cover in this webinar is basically calculating and interpreting the basic investor ratios. So we will be discussing about ratios which are calculated using the income statement, ratios that are calculated using the balance sheet, and various other ratios that are useful for investors. So let's move on to analyzing the key financial statements. Right. So I will be starting with the income statement. Now, anyone who have done accounts would know that when a business carries out transactions, there are four types of accounts in which they get recorded. Even if you have not done accounts, that's perfectly okay. It's simple to understand. Any business, when they carry out transactions, these transactions are recorded in four different types of accounts. This would include income accounts, expense accounts, asset accounts, and liability accounts. So income statement is predominantly concentrating on the incomes earned and the expenses incurred by an organization within a particular time period. To make things more simpler, we'll say for a particular year, financial year 2020, what are the incomes that have been earned by that company and what are the expenses that have been incurred by that company. Note, I use the words income earned and expenses incurred. The difference is not that every income that you earn might have been received during that period. Similarly, not that every expense that you have paid for might not have been incurred during that period. So irrespective of whether an income is received or not, irrespective of whether an expense is paid or not, you have to take what is relevant for that particular time period. If it is a 12-month period, you take what is relevant for that 12-month period. So in the income statement, what we basically do is we compare the incomes we have earned with the expenses we have incurred. Simple as that. So if the incomes what you have earned is in excess of the expenses that you have incurred, you have earned a profit. If the income that you have earned is less than the expenses you have incurred, we say that the company have incurred a loss. So by looking at the income statement, you can see whether that company have incurred a profit or a loss. So profit is where they earn more income than the expenses. Loss is where they have earned less income than the expenses. Now, as investors, you should focus on profit growth, especially where there's good potential for future profit growth. Right? So we won't be teaching you all how to prepare income statement, which is beyond our scope. But we will take you through a sample income statement for you to understand the format of it and to realize what are the things which are important to look at. Right. Now, this is the income statement for year ended 31st March 2020, the annual income statement of a particular company. Now, in any income statement, the first line will be revenue or sales. So simply, this is the income a particular company have generated from their cooperation. For example, we'll say this is a garment factory. So revenue is the income they have generated by manufacturing and selling garments. If this is a electronic goods manufacturer, this is the income they have generated by manufacturing and selling electronic devices. So that's the revenue line. More often we call this the top line of a business. So this top line, to generate this top line or to generate this revenue, a business would incur a cost. You call this the cost of sales, the cost of what you sold, not the entire cost of the company, the cost of what you sold. If I take the previous example, if this is a garment manufacturer, revenue is the income you generated by selling the garments. Cost of sales is the cost that you have incurred to manufacture the garment. The difference between revenue and cost of sales is known as the gross profit. So now gross profit is one main item which you in the balance sheet which you need to monitor, right? So you have to see whether there is revenue growth. So in this instance, there is revenue growth of 18% in this company, and gross profits also have increased. So if a company cannot cover their cost of sales out of their revenue earned, that means that company can't be profitable, right? Their revenue is not sufficient to at least cover the cost of what they sold. There are so many other costs which they need to cover apart from the cost of sales. So you need to see whether a company is capable of covering their cost of sales and generating a positive gross profit. Now I said revenue would include only the income which they have earned from their cooperation. But there can be so many other sources of income. For example, dividend income, rent income. If the company has a building which has given on rent, they would generate rent income. So those incomes are classified under other income. Just like other income, there can be certain other expenses apart from cost of sales, right? These other expenses are mainly categorized into two categories: sales and distribution costs and administrative costs. Now I said cost of sales includes only the cost of the goods sold. If it is a manufacturing company, only the cost of manufacturing. There can be certain other selling and distribution costs, such as the advertising costs. So that will come under distribution cost. Then administrative cost. The salaries and wages you pay for the office staff will come under administrative cost. If you are paying rent for your offices or your showrooms, that will come under administrative cost. So these are the other costs. So what you do is first you match your revenue against your cost of sales and calculate your gross profit. To that you add any other incomes and deduct any other expenses. Then the resulting figure is known as the operating profit. This is another key figure in the income statement which you need to look at. Operating profit, or you call it the profit before interest and tax, right? So this is basically the profit the company is generating through their operations. So in this instance, this company has generated an operating profit of 2 billion. Year on year, compared to 2020, they have generated a 13% growth. So after operating profit, what you do is you adjust for your finance cost. That is, if you have any borrowings, you need to pay interest expenses. And if you have any deposits, you will be earning interest income. So you can net off your interest expenses against your interest income and account for the net finance cost or net finance income. So in this particular company, it's a net finance cost. So that is why it's a negative figure. So that means they are paying more interest than what they are earning. So paying interest is not a bad thing as long as debt is used for the correct purpose. So if there's any other associate companies in this group, that profit earned through the associate company will be taken under the equity method of accounting. We will not touch that area for the time being because we are still at the very beginning. I don't want to confuse you all. So after you adjust for your finance cost from your operating profit, you arrive at your profit before tax. So this is the amount of profit that this company have generated before paying tax. So in this particular instance, they have generated a profit before tax of 1.6 billion compared to 1.3 billion in the previous year, which is a 23% growth. From that, you need to deduct your interest expense. I'm sorry, I beg your pardon. You deduct your income tax expenses and you arrive at your profit after tax. So profit after tax have grown by 34%, which is a very decent growth rate for a company. From that, you have to adjust for your non-controlling interest. Please don't worry about it. Non-controlling interests are investments that you have made in your subsidiaries where you don't have control. So you have to deduct that. And what shareholders should really focus as the profit of the company is the profit attributable to the owners of the parent, right? This is the profit which can be distributed amongst the ordinary shareholders of a company. Okay, so what we did here is actually a horizontal analysis, right? That is, we compared each of the figures with the previous year figure, right? So this method of analysis is known as the horizontal analysis of an income statement, right? Horizontally, compared to the previous year, what is the growth in the current year? So top line have grown by 18%, operating profits have grown by 13%, profit before tax is up by 23%, and profit after tax is up by 34%. So this is one thing which you need to do when you analyze the income statement, the horizontal analysis. So for you to do that, you need to be comfortable with the format of the income statement and have a rough understanding as to what each of these line items mean. So that is why we thought of sharing some introduction into the format of the income statement. Okay, now let's look at some of the ratios that you would be calculating using the income statement. Right. Using the income statement, you should calculate the profit margins of the company. What do you mean by a profit margin? Now, you saw in the previous format of the income statement, we calculated several profit lines. First the gross profit line, that is sales minus cost of sales. Then you calculated something called the operating profit. Then finally, you calculated the net profit or profit after tax. So what you can do is, you divide these gross profit figures, each of the profit figures, by the revenue that company have earned. So when you divide the profit by revenue, you call it the profit margin. So for instance, if you divide gross profit by revenue, you get gross profit margin. If you divide operating profit or profit before interest and tax by revenue, you call it the operating profit margin. If you divide net profit by revenue, you call it the net profit margin. So you need to see whether these profit margins are increasing or reducing. Now, this sort of analysis is known as a vertical analysis. If I go back to the previous slide, I said, if you compare year on year, that's known as horizontal analysis of an income statement. Now, vertical analysis is you compare each of the figures in the income statement with respect to a base figure. So what I did is, I divided the gross profit by the revenue figure, that is 3.9 billion by 23.2 billion, and calculated the gross profit margin for 2021. So that's the vertical analysis. You go vertical. So the base is revenue and gross profit is the figure which I am analyzing. So you can calculate the gross profit margin in 2021 and compare with the gross profit margin in 2020. So for this company, if you look at it, in 2020, the gross profit margin have been 17.1%. That is, if you divide this 3.3 billion by 19.6 billion, you will get the answer as 17.1%. In 2021, it have come down marginally, down to 16.9%. So though there is growth in the top line, the gross profit margin have marginally come down. So it's nothing alarming, but something which you should focus on. So why this happens is that the increase in the cost of sales is faster than the increase in revenue. That's why your gross profit margin has come down. So similarly, you can calculate the operating profit margin. That is, you divide the operating profit in each of the years by their respective revenue figures. And you can see what has happened to the operating profit margin. Now in this company, the operating profit margin again have come down from 9.5% to 9%. So the operating profit margin also have marginally come down. So it need not always be the profit figures. In a vertical analysis, you can calculate any figure in the income statement with respect to a particular base year. For example, you calculate the administrative cost as a percentage of revenue, right? If you calculate in this company, it has been 3.6% in 2021. In previous year, it has been 3%. So that means compared to the revenue growth, the increase in administrative cost is higher. That is why when you calculate administrative cost as a percentage of revenue, it has increased from 3% to 3.6%. So in vertical analysis, theoretically, you can take any of these line items and calculate that as a percentage of a base figure. So generally what we take as the base figure is the revenue line, right? Compared to revenue, how has any of these cost items behaved? So that is known as vertical analysis. So coming back to the ratios, you should calculate your gross profit margins, operating profit margins, net profit margins for 2 consecutive years and see how these margins have behaved. Have they improved or not? The second ratio you should calculate using your income statement is the earnings per share figure. You call it the EPS. So how do you calculate EPS? You divide your profit attributable to equity shareholders by the weighted average number of shares in issue. Very simple. If you go back here, in this particular company, they have generated a profit of 1.19 billion or 1,191 billion. These figures are in thousands, right? This profit, you divide it by the number of shares that are in issue in this company. So if you divide this figure by the number of shares, you will get the earnings per share as 4.97. In very layman terms, what we calculate is how much profit is attributable to a single share of this company. They have generated 1.1 billion for all shareholders. How much have they generated for a one single share? So this company is generating 4.97 rupees of earnings for a single share. So that's the meaning of earnings per share, right? So it's self-explanatory by the name earnings per share. For one share, how much have they earned as profits? So there again, what you can do is you can calculate the EPS and see whether there has been EPS growth. So there have been EPS growth. Last year 3.44, this year 4.97 rupees. Now this can also be used as an basic indicator to gauge how much of a dividend this company is capable of paying. This is not the only way to look at it, but this is one indicator that you can use. Then the third ratio which you can use, calculate using the income statement is the price earnings ratio. So what you do is simply you divide the share price of a particular company by its earnings per share. Before I go to the explanation, I'll just take a simple illustration. We'll say that a particular share is trading at 10 rupees and this company is earning 2 rupees per share earnings. Share is trading at 10 rupees, EPS is 2 rupees. So you are paying 10 rupees to own a share which has the earning capacity of 2 rupees for an annum. The share can earn you 2 rupees for an annum and you are paying 10 rupees to own this share. So in very simple terms, if you buy this share at 10 rupees, it will take 5 years theoretically for your share price to be earned by the company. You pay 2 rupees, sorry, you pay 10 rupees to own this share. Share has the earning capacity of 2 rupees per annum. So that means it will take roughly 5 years to earn back the price that you have paid. Okay, that's on a theoretical note. Now, some people interpret the PE ratio as it's good when the PE ratio is low. Yes, as a general rule, some can say that low PE is low. Low PE is good. That is because you are paying a lower multiple to own this share. But at the same time, a higher PE ratio demonstrates that there is higher investor confidence. Now, if you look at many companies listed in the Colombo Stock Exchange, there are certain companies which are trading at low PEs. And if you historically check their results, those shares have always traded at low PE multiples. Similarly, there are certain companies which are trading at very high PE multiples, and historically they have traded at very high PE multiples. So higher PE doesn't necessarily mean that share is bad. And low PE does not necessarily mean that share is good. Low PE means it is undervalued compared to its fair value. Higher PE means the share is overvalued compared to its fair value. But you need to make your decision by looking at certain other criteria as well. Why is someone paying a higher price to own a share? Because they have confidence that this particular company will do better in the future. Why is a particular share trading at a low PE? That may be because there's less confidence that this company will do better in the future. So that's why I said you can't classify low PE companies as always good companies to invest, and you can't reject high PE companies as always overvalued companies which you should not invest. You have to see by how much their earnings can grow in the future. Okay, so that's about the PE ratio. So how you calculate the PE ratio is you divide the share price by its EPS and see how many years worth of earnings am I going to pay to own this share. So I hope that you all got some basic understanding about the fundamentals. Now the program, what we are going to do is the first part of the session, we will be discussing about the fundamental analysis. And the second part of the session, we will be discussing about the basics of technical analysis. So I think I have gone little beyond the time that was allocated for fundamental analysis. So now I'll hand over to Saliya Gamagadara, who is our manager sales at SC Securities, to discuss more about introduction to technical analysis. And towards the end of the session, we will have a Q&A session. Saliya, over to you.
Thank you, Charitha. Okay. Welcome all of you to this session, and it's a privilege for me to share the basics the way I understand with you all, so that I believe you will certainly benefit out of this. First of all, as far as studying the charts are concerned, I would like to take you all through the website called investing.com. Some of you all must be aware and familiar with how to use it, but since we are just starting in this session, as we are covering the basics, I believe it will be worthwhile for us to get connected to investing.com from the start itself. You you go to investing.com like so, and click on it. Okay, once you come over here, you can, here of course I have logged in through my signing in credentials. I suggest that this is a free sign up, so that you it will be worthwhile for you all to sign up, fill up the sign up form and get going with it. It'll be useful. You can either use your FB credentials or the Google credentials, or you can use your email in order to do your signing up. You enter your name, email address, and whatever the password that you want, and click on sign up. You will be taken to your email address, rather to your email, so that you will be able to use their links to get the signing in done. Once you do it, you can use your email address like this and click on your password and sign in. Once you are in the website, this is the main page that you're getting, right? And in order for us to access the respective charts that we want, we go to the search menu like this, and let's first of all go to the all share index. It's known as Colombo, or rather CSE all share. We click on CSE and we come to the CSE all share, click on that. Then thereafter we are taken into the CSE web page within the platform, or rather within that site. Over here, now we are interested in moving into the charts. So for that, what you do is you go here to technical charts, click on it, and then you will get the chart in this page itself. In order to go to get the chart separately, we go to this icon here and enlarge, which is known as the enlarge icon. You enlarge the chart. Once you are in the chart, this is by default. This is the chart that you will, or rather the window that you will get. And here it will be very important for the most basic person to understand what really is given here, so that it will be very useful for us, moving forward, to be familiar with what is available here. Now, first of all, you need to understand, even though you can't see, this window is broken into two segments, right? You can see if you just expand the middle section, this horizontal line over here, you will see that this chart is split into two, right? And what are they? By default, they are giving you the chart itself. I'll come in a minute to what it means. And then also the next section is the section called volume. At the same time, this volume, once you double click on the volume index itself like this, and you drag it up, you will see that both those features will appear in one single window like this. Thereafter, we need to understand what this chart is all about. Now, this chart is called a chart style, and this chart style is the area chart. Now, we need to change this for our study purposes and to move forward, right, into a different style. And those styles can be selected by clicking onto this down arrow like this. And you have different types of different styles of chart patterns over here. And the popular chart patterns are the bar charts, the candlestick, then the line chart. And amongst them, the most populous is candlesticks. So we click on the candles. Now we are here on the candlestick chart on the Colombo Stock Exchange All Share Index. And at the same time, we have added another feature, which is the volume. In the case of okay. Thereafter, we need to understand that the charts are given over here based on time periods. And what are the time periods? Now, this by default is called a daily chart. In other words, the data which is given here are confined to every day. Hence, it is known as a daily chart. If you go to this down arrow, click on it, you will see a drop down with different time frames given here. From a longer period as 1 month to a shorter period as 1 minute. Incidentally, you can use your online platform and make use of the chart window available in the online platform. As you all know, we are using the ATRAD platform, and in the ATRAD platform also you will be able to access the chart window like this. But there is one difference here. In the case of shorter time frames, the data available in the ATRAD is minimal. Therefore, let's see if I have time. If you connect to the ATRAD terminal, you will see under the feature called analysis, you click on it, move into advanced charts, click there, you will come into a different tab with this window. Over here, we have to choose the security. By default, you will see the candlestick chart. But if you go to shorter time frames, like a 1 hour chart and downwards, you will get data of this nature, which is not user-friendly for our analysis. Therefore, if you go into the investing.com, it's a different ball game altogether, where you will be able to see the 1 hour charts, even shorter than 1 hour, 45 minutes, even 1 minute chart, where the necessary data is available. Okay, now I would like to go take you all through the rest of the screen here. Onto your left side, you can see there are many features available which we are using when we are propagating or designing our own chart with analysis. We will be using all these tools. So this is basically a tool menu that you have on your left side. Then, as I mentioned, these are the time periods, different types of time periods. And then these are the chart styles. Then over here, you have the settings. What the settings are for the chart itself. If you click on this, you can change these colors of the candles. You can also keep the price line and so on and so forth. You can change the background. You can change the colors of the background and so on and so forth. Then you come to the next icon, which is the indicator menu. you click on the indicator menu, you will see a load of indicators given here, right, which we are using to do our analysis. The next icon is a comparing symbol, meaning you can compare whatever the security that you are in with another security, right? If you go to along with the ASI, if you want to see Dow Jones Industrial Average, you can do that. That's the difference between using the ATRAD chart and the investing.com, because the investing.com is covering all the capital markets in the world. Therefore, you can compare any of them along with whatever the instruments that you are interested in comparing with. The other what do you call the feature is that these buttons are, you can go back or come forward by using the forward and the reverse arrows, like that, the way I just now did. Okay, so that is basically what you have in the chart, and onto the right side you will see the values, right? In the chart, the values of the respective chart. And then also, if you come down to this panel over here, you will see the time period. Then at the same time, over here, you can change the time zone. Since we are using 5.5 GMT, we can go to that, which is here, Kolkata, 5:30 UTC. Then we are in our local time. So basically, these are the important nitty-gritties that you need to understand in the screen. This is very useful and very informative. We are moving into reading the chart, and that is the most important thing that we need, right? In technical analysis, a little while ago, Charitha took you all through how to read the fundamentals. When it comes to the technical analysis, technical analysis will be helping you in reading the prices. Now, that is the primary objective of having technical analysis, reading the charts, right? There are different types of interpretations, but the crux of the matter is that when you are using the charts in technical analysis, what we do is we study the fluctuations, the ups and downs of the prices of respective instruments, so that we will be able to make use of the tools, as I mentioned, on the left side of the chart and the indicators, for us to come up with an informed analysis of at which point to enter, in other words, to buy, and at which point to exit. Now, in the case of the candlesticks, itself is giving you a snapshot of the behavior, price behavior for particular periods. In this case, we are using the daily chart, as I changed it to daily, and here you can see the day is mentioned over here, and every candle that you see here, all these vertical short bars are called candles, and all these candles, each and every candle is a snapshot of the details for that period, for every day, because this is a daily chart. Let's zoom this and see what those candles are really telling us. If you take this, top candle over here, you can see it's a red color candle, and incidentally, a red color candle is when the prices are down. The green color candle tells you that the prices have gone up on that day. Now, the red space or red section of this candle is called the body of a candle. Then you can see two little lines on the top and the bottom of a candle. They are called the wicks, and the edge of the upper wick is the high value for the day, and the edge of the lower wick is the low value for the day. Inside the body, if it is a red candle, the top of the body is the opening price. The bottom of the body is the closing price. So basically, you have 4 values given in each candle: the open value, the high value, the low value, and the close value, which is known as open, high, low, close, or OHLC. Now, when you're moving the cursor, you will see the values over here are changing, and those are the values for each and every candle. Now, on this, you can see the open value is 875.73, high is 9025.82, low is 8622.53, the close is 8668.03. Now, that is how you read specific candles. From there, you need to understand the next important, these are the details given for the prices. And the next important indicator or the available data that is given to us is the volume. In technical analysis, we believe the prices and the volumes are very important, because end of the day, that is what we do, right? We buy a share at a particular price and a number of shares. Therefore, the fluctuations are dependent more strongly on the fluctuations of the volumes or the behavior of the volumes. Therefore, we very seriously look at the behavior of the volumes, and that is also one of the basics that we have to remember. The key basics that we need to keep in mind is that the price fluctuation is important along with the volume. Thereafter, we need to understand what we really mean by the fluctuations in prices. When it comes to technical analysis, we break it out or break it down to 4 parts. One is the uptrend, number 2 is the downtrend, and there is the number 3, the support, and the number 4 is the resistance. At every given moment, you have the support, rather you have the uptrend, the downtrend, the support, and the resistance. Now, for the up and the downtrend, how we classify an uptrend is when the lows. Now, I mentioned that all these wicks at the bottom of these candles are called the lows. And in an uptrend, the lows have to increase, right? We call it the higher low formation. Higher low formation, right? Every high, or rather every low has to be higher than the previous low. If you take the lows over here are lower than the lows you can see here. So it's an higher, it's within a higher low formation. And it's an uptrend as a result of that. Followed by the higher low formation, you see the higher high formation. meaning the highs are increasing from over a period of time, from the previous day to the present day, and continue. And that is what we can see over here. If you take the highs over here are lower than the highs here. Basically, the highs over here are higher than the highs here. Now, every day, right? If you take a day in the Sri Lankan market, we have 3.5 days, 3.5 hours, I'm sorry, right? Therefore, the 3.5 hours are broken into minutes as well, right? It can be broken into 45 minutes, 15 minutes, 30 minutes, even 5 minutes. So basically, you can evaluate or by using the data according to your time preference, according to the time periods that you need to analyze when you are using the price behavior. And we call the price behavior as price action, right? So once the uptrend is over, the downtrend is classified as lower high formation. As you can see here, this high is higher than this high. This high is lower than this high. So there is a lower high formation. This high is lower than this high. Then followed it up with the lows. This low is lower than this low. So when there is a continuation of lower highs and lower lows, it is described as a downtrend. We don't loosely call it a downtrend, or we don't loosely call it an uptrend. Just because we see a ticker in green or ticker in red, we don't classify as the market or the stock as in a downtrend or an uptrend until we understand whether it's in an uptrend or a downtrend based on our classifications. At the same time, the next feature of an uptrend is the time that the trend goes into a sideways movement. That is known as the resistance area. And over here, there is a continuation of the price with higher lows and higher highs. And over here, you can see that there is a pause to that continuation. For in this case, of course, only 2-3 days, but there is a pause. And that pause is after the pause after an uptrend is known as a resistance. Then similarly, when the prices are in a downtrend where you see a lower high and a lower low formation, at any given moment that there is a sideways movement that is known as support. I'm not going to describe what support is. I'm not going to describe what the resistance right now, because we wanted to just touch on the mere basics and take you all forward to the next sessions. As a result of that, we will be discussing a little bit further, more elaborately with examples of how this resistance and support is going to perform, because that's very important for us to master if we are really interested in understanding and learning technical analysis and using them for our our decisions of buying and selling. Now, another important feature that we need to understand, and with that I'm going to close, is known as a breakout. Now, breakout can happen from the top of a price or from the bottom of a price, from the high of a price, or rather, put it simply, from the high of a candle order or the bottom of the candle. Now here you can see what it means is that this uptrend pauses here and goes into a sideways move. The moment the price starts increasing and go above the previous high, that is known as a breakout from the high. When the prices are falling with lower high and lower low formations and moves into a sideways movement like this, which is also known as support, and the prices start continuing to fall, and the time this low is broken and the prices are continuing to come down, it is known as a breakout from the low. So we need to understand, in a support or in a resistance, there are two types of breakouts: from the high or the low of that support, or from the high or the low of the resistance. Until the breakout takes place, we cannot classify that whether the trend is extending or the trend is failing. Now, the trend extensions and trend failures also will be looked into at forward sessions, and that is very important for us to understand when a breakout takes place. At the same time, the breakout is not only taking place within the resistance and the support areas. Every day, each and every candle has a breakout. When the lows are increasing into a higher low formation, the highs have to break the previous high. Otherwise, we cannot call it as an uptrend where the prices are increasing. You can see this low is lower than this low, making a high low formation. But if the high, or rather if the price didn't break this high and make a new high, the prices wouldn't have extended, right? Similarly, on the opposite direction also, if this low is not broken down, right, this low will not be, the prices won't come down for another low to form. So breakouts, the uptrend, support, resistance is what we need to understand in the price action or the price behavior. And also, we as technical analysts, we believe that the prices are moving in waves, different types of waves, longer waves, shorter waves, and so on, either way, up and down, right? So that's basically what I want to cover today. And on the next session, we will be taking you all through a little bit more into advanced explanations about how we make use of technique in order for us to make our buy and sell decisions. So with that, I will hand you back again to Charitha to move into our Q&A session. Thank you very much.
Right, thank you, Saliya, for that insightful presentation. So the floor is open for any questions. We have a few minutes left. So if you have any questions or queries with regard to fundamental analysis or technical analysis, please send them in now. We are more than delighted to answer them.